Hello, everybody. My name is Garrett Jones, and we are back at you with another episode of Home Equity First. I've got Arioche Salas here with me today, and his company. Is that correct?
That's
Move
correct.
Money Safely,
That's
and
right.
uh, and I'm excited to have you on and learn a little bit more. We got to talking last week, and I think you have a tremendous product offering for people who are looking for different ways to protect their assets and save a little bit of money from good old Uncle Sam.
That's it. That's what we do.
That's what you guys do. So tell me, how long have you been in the real estate business? Give me a little background on you and what you love about your job.
Yeah. So I've been in the real estate space on and off for a long time. Mortgage license. My wife's in real estate. Been an investor. My first real estate transaction purchased when I was 18 years old in the city of Sunnyvale, California. Uh, so I've been in real estate a long time. The team that I work with now, they have about 30 years experience in what we're doing, right? So uh, what we're helping clients do is move assets, minimize tax, and place their money in more liquid uh, assets so they can have access to their money in retirement. What people don't understand is when they sell an asset that's it's highly appreciated, and where we're at in the Bay Area, if you invested in real estate in the 90s, 80s, 70s, the further back you go, you have a lot of gains. The Uncle Sam, as you mentioned, is going to take a big chunk of that, right? In some cases, I've seen it where it's been over $1 million that is going to some sort of franchise tax board, IRS, uh, and it really puts a big damper, I guess you would say, in someone's retirement when a big chunk of their money has to go to somebody else.
Right. Right. Yeah, it makes it hard to retire the way you want to when you're cutting a six-figure check to the government. Let let's run through a scenario. So let's just run through a scenario so the listener can have a better idea of understanding what we're talking about setting up here. So we've got a couple, they're living in their primary residence. They bought the house for $100,000. Okay, and they're considering selling that house now. And today it's worth $2 million. Um, Explain how you come into this scenario because this is what you're helping people with, and and then what needs to happen in order for them to set up the structure to protect that asset.
Yeah. So the first thing we do is analyze, their tax liability, right? What is it that if they did nothing, right, do they really need to sit down with a tax strategist, right? There's different, you know, instances where a step up in basis can occur, and the basis is what the IRS deems as your cost basis for that property. So we go through analysis and figure out what is it that they purchased the property for, what capital improvements they've done. So this family might have, done a $400,000 remodel to the house. So now their basis is 500,000, right? Because they're married, they have a 121 exemption that's
Here,
going
let's pause for a second in case some of the listeners don't understand what a step up basis means. What we're
to.
referring to is an amount that will not be taxed. Correct?
Correct. Correct.
Okay. So we've stepped them
So
up. They've done 400 in capital improvements. They've got $100,000 purchase price, and then
correct. So
and then back to you. Sorry for interrupting there.
no, not at all. So clarification is key. So now their cost basis is 500,000. If you look at it in any kind of business, what you purchase a property for, any improvements is now your cost. Anything above that is profit. Now the IRS gives us an exemption of $250,000 if we're single, and 500,000 if we're married. So in this instance, now that client has $1 million that is exempt from taxes, right? But the other $1 million, that's where we're going to get taxed. And on $1 million of capital gains, the IRS is going to hit you at a 20% uh, tax rate. It could be higher depending on what your income is for that year. and then the IRS or the franchise tax board, the state of California, is probably going to tax you another 17 or 13.3% and a 3.8% Obamacare. So total tax about 37%. On that $1 million, that's $370,000 that you're going to lose out on.
Okay, so now we've analyzed the tax situation for this couple, and what solution do you have that may be of benefit if we still want to sell that house?
Yeah. So the first thing we ask the client is what are their goals? What do they plan on doing with the net proceeds? Right. So let's say that this client wanted to move to Nevada because their kids live there and their grandchildren live there, right? And they found a house for $500,000 that they would like to downsize and purchase in Nevada. So what we would do with this client is, prior to listing that property, we would secure a line of credit for their original 100,000 cost basis and their 400,000 in capital improvements. Assuming they own nothing on this property, they can take a $500,000 loan and park that money in a bank account, right? When the realtor sells that property, that $500,000 loan is going to be paid, right? It gets paid off in full. Essentially what they did is they parked $500,000 that they can now use tax-free to go purchase their property in Nevada. Now, the other $1.5 million that is left, right? This is where a tax strategy comes into play. So the Internal Revenue Code, and what I like to call the Internal Revenue Code, is a playbook. I played a lot of sports in football, and it's a playbook, right? Some people might look at it, your CPA, your tax preparer, as to what you have to pay in taxes when they see you in April. Right? We look at that tax code a little bit differently, right? We look at it as, okay, what can we do ahead of time to minimize or defer those taxes? So the Internal Revenue Code 453, or IRC 453, is installment sale law. And what that states is, if you do not have receipt or control of the money, the tax is not due. So if you were to owner finance that leftover, that $1.5 million, and an individual was to purchase that property, and you did, for instance, an interest-only owner financing, the tax, even though you have this gain of this $1 million, right, you don't have to pay the tax because you haven't received the money. It's pretty risky to do owner financing to an individual for two reasons. One, you don't know if they're going to pay you, right? A lot of things can happen. They can file bankruptcy, and then you have to, foreclose, and a lot of things can happen in that instance. Or they can come up with the money and actually pay you, right? You have to receive this money, and now the tax is due because you received the money. So what we do instead is we have our tax attorneys that have been doing this for over 30 years. They actually have a private letter ruling from the IRS on this structure. They set up a irrevocable business trust, right? Mm-hmm. So what this trust is set up for is so that you can sell from, whether you're the individual or your living trust, sells to the business trust for that same $2 million. And then this business trust for $2 million sells to the end buyer. So Garrett, if the trust purchased for $2 million and sold for $2 million, would this trust that was set up have a capital gains? No, because it purchased for $2 million and sold for $2 million. Now, through title and escrow, commissions are paid, that $500,000 loan is paid, and the $1.5 million falls into this trust. Now, the living trust that originally owned the property, or the individual, is owed all that money in this trust, right? So that's where you did owner financing to the trust. Now, the cool thing about this is that money could be then invested, right? It can be invested in the same fashion that the client was going to invest the after-tax dollars, except now you have more to work with, right? So you have your money and the IRS's money generating you interest in retirement. And in some cases, like this person, that tax was $370,000 that's going to be working for you. But I've had it where it's been $1 million. So, obviously the bigger the gain, the more the tax. If you had $1 million generating you interest, you'd feel pretty good about it, right? So it's very powerful things or stuff that can happen when you strategize and you're able to do these things in a fashion that saves people money. So that client there has that $1.5 million, and let's just assume it made 10% the first year.
Can I
Right. So,
ask you before we go on to the 10%, who's
yeah.
in control of this trust that is now set up with the $1.5 million? Who's managing that money? Who's managing the investment? Is it your company, or is it an
So we
outside financial planner? Is it me, the property owner, or the trust owner?
great question. So the way this works is it's really three parts, right? So I'm a financial consultant. We also have financial advisors on our team. The tax attorney is going to hire an independent company that all they do is manage trust. So there's a trustee that's separate from the people that go over the suggestions on the investments. The individual owner that sold the property, though, is realistically, they're the ones that decide where the investments get made, where they get placed. So the money that's in this trust, if the client says, I'd like that money to go into a Charles Schwab account, I'd like to invest it in this kind of stock, then that is what happens. And the trustee's there to make sure that that takes place. As the consultant, the advisors on our side, we go over suggestions with our client on where that money can be placed, where it could be invested. They ultimately have the say in where it gets done, and then the trustee, the third party person, makes sure that that actually takes place. So that's how that happens.
And then,
So now,
and as I'm spending that money, right, as I'm pulling it out to do things with it, I still get my exemption. And then once I spend all of that money, now I'm paying taxes, or how does that work when I'm using the money?
yeah, so this happens in two different fashions. It depends on, let's assume that $1.5 million made 10%, made 150 grand, right? If that client says, you know what, I don't need 150 grand to live on, I only need 100,000. So when they take that 100,000 in distribution, because it's gained from that 1.5 million dollars, they will only pay they will pay ordinary income tax on that 100,000. The other 50,000 that remained in the trust. The cool thing about this is the trust didn't make that money. The trust now owes that client, that living trust or that individual, 1.5 million plus 50,000. So that amount that it owes out is not profit to the trust. It just owes more money to the individual. So that money will compound and grow inside that trust, right? Similar to like an IRA or a 401k. So
So we've
it's
got the
deferred.
compound effect here
You
in
got the compound effect, right? So
full
so you
motion.
deferred the capital gains, and now you're also deferring the growth of what's left over in this trust. Now, the cool thing is that 100 grand that individual took out, they will pay ordinary income tax. Now they live in Nevada, so they will pay the federal, income tax, but they're not going to pay any state income tax, right? So that's also powerful in that now their dollars are, going to be, giving them more money in that they don't have to pay state income tax. Now, let's assume that client now wants, they wanted more money. They wanted the 150,000 they gained, and they wanted another 150,000. So they wanted 300 grand. They will pay ordinary income tax on the 150,000, and then the other 150,000 is a pro rata share of that 1.5 million. Now, they had 500,000 that was exempt out of that 1.5 million that was left in the trust. So essentially, 1/3 of that money is exempt. So when they pull out the other 150,000 that is capital gains, they will not pay taxes on 50,000 of it. They will only pay taxes on 100,000 of that capital gain. Now, on this capital gain, depending on their income, but if this is all their income they're receiving is that 150,000 in profit that trust generated, and this other 100,000 in capital gains, they're only going to pay 15% on that 100,000,
Versus
and they're
30.
not going to pay any state capital gains tax. So essentially, pull out that other 150,000, it costs them 15% on 100 grand.
So they're not going to pay the other state as long as they move to a state that doesn't have a state tax,
Correct.
right?
Correct.
Wherever their primary residence is. How
Correct.
so with what you're doing, how often do you come in to advise and consult somebody, and there are other financial planners and other people involved in that conversation? Because this is a big movement of their wealth for most people.
Yeah.
Um,
Yeah.
what is it? I guess what I'm looking to understand is what is the time frame usually look like for the families that you help or the individuals that you help to make a decision and actually and move through this process to get it all done.
Yeah. Typically, we want to educate a client a month or two prior to them listing the property, right? So going over, because it's something that they're going to have to understand and learn before we move forward. And, typically I'll meet with a client two times, maybe three, and then they meet with the tax attorney, the law firm that has been doing this for over 30 years, and they meet with the trustee, right? So there is a process to this. Sometimes the client, like for instance, the scenario that we just talked about, the client wanted to purchase a property in Nevada. So we wanted to exit some money. So there's a loan that gets done prior to the sale that could take a few weeks or months. So you want to make sure that we're planning and we're giving the client all their what they can do to exit the most money strategically to minimize these taxes. So I would say a few months prior to listing the property is key to making sure someone understands it. Now we can work quickly also. So if there's a client that's got a house that they're listing it in a week, we could still get that done. It's just now you're rushing through getting to explain this to a client and understand it. And typically when you're rushed, clouded minds don't move forward, right? So you want to make sure that, that the client understands the whole process of what this is, how it happens, uh,
So
and so on.
so when you do you see the biggest challenge in this is that you're oftentimes just dealing with seniors and one change is hard and also this education process can be challenging for people as well, right? What do
It
you
can
see
be.
as the
So
biggest challenge to because it's obviously an advantage if I want to sell. I mean, uh, to
yeah.
to protect my asset, but what are you finding is like the pushback from the people that you're speaking to about doing this?
Yeah, great question. So I think the biggest thing is that people believe that when they sell the house, they want their money in their bank account, right? So this money is sitting in a trust and all that money is owed to them. They have a promissory note that says that all this money is yours and everything it grows to is yours, right? But it's not yours until you actually take it. Now, when you take it, you have to pay taxes, right? So a lot of people don't need $1.5 million in your bank. So if you're going to take $1.5 million and place it in your bank account, then you got to write a check for 370,000 to the IRS, or you can have that $1.5 million, all of it growing for you. And as you need money, 100,000, you pay minimal tax. That's the play here. So, understanding that all the money that's there is owed to you and it's all yours if you want it, with the understanding that you got to pay taxes when you receive it. That sometimes, makes people a little nervous. Now, at any time, they can take the money from the trust and pay those taxes. So it's not like it's locked up in this vault where you can't get to it. You can. It's just you have to pay taxes.
And I know that the cost on it varies, but other than the multiple steps to set it up, I'm not really sure why any senior selling a house who owes six figures in tax implications after selling, I don't understand why everyone wouldn't set this up, right? But could you? I know you have more than just this product to offer people, but for today's call, we'll just focus on this one. Could you give just a brief overview on what the cost is to set up this trust?
Right. So the good thing is we're a lot cheaper than doing business with the other guys. And when I say the other guys, I mean Uncle Sam, who's going to charge you 20% in state California, another 17%. So it's not 37 or 40%. Our tax attorney charges 1.5% on the first $1 million and 1.25 on anything thereafter. So in this instance, a $2 million sale, $27,500 is the cost of setting this up with the attorney. What they do for that amount of money is they set up the trust. They do the assignments that are necessary in the sale of the asset from you to another individual. They set up the promissory note that is owed back to you. They also offer, and this is part of the engagement with the law firm, is that they offer free audit defense. So if the structure ever did get audited, and know this, they've done about a little over 4,000 of these structures over the last 30 years. They have been audited about 30 times. All 30 times it's passed without a change audit. So they want to protect their work, and this is their livelihood. So if there ever is an audit, they are going to defend you free of cost, right? That's part of the engagement with the law firm. So that's the initial setup with the attorney. It's a one-time, they set it up and they're done. And then there's ongoing trustee charges, that management company that is there to police and do the annual tax returns for the trust, which is typically a zero tax return because the trust is not making profit from this. The trustee charges 0.75%, 0.75 for whatever's in the trust, not on the sale transaction, but whatever's left in the trust. So in this instance, it would have been that $1.5 million. That's what they're charging on an ongoing basis.
Okay. And also, right, this setup fee is not due unless the transaction actually goes through.
Correct. So yeah, great question. So the tax attorney has to set up the trust ahead of time, right? You can't sell to an entity, enter into contract, and then create the entity after the fact, right? That wouldn't work in the eyes of the IRS. So the tax attorneys are setting up a lot of their work ahead of time, and you sign an engagement of which it only gets paid if you follow through and the money falls into the trust. So at that point is when the tax attorney will get paid, the trustee gets paid his first year, and so on. So typically what we do is we meet with a client, we explain everything through the process. They meet the tax attorney, they sign an engagement, the tax attorney does all their work, and then when the sale happens, they get paid. If the client decides the last minute that they don't want to move forward with this, there's no obligation to pay the tax attorney or do anything. So part of their engagement and what they do is, once the money flows through title into the trust is when they take payment.
That's awesome. Well, hey, thank you so much for your time. And we're going to do this again next month, and we're going to learn about a different product if we can carve out another 30 minutes.
Yeah.
Arocha, I'm going to have your contact information down in the notes here if anybody wants to get a hold of you. And then I'm going to share with you all the great stories we have putting deals together. So
Awesome.
thanks everybody for
Appreciate it, Eric.
listening, and I'll talk to you soon.